All right, we got a bonus edition of What's on Your Mind.
Yes, indeed. Well, we were talking the past few days and few weeks about the markets, and you were, I would say, excited, maybe the wrong word, but anticipating an opportunity. And we thought, good time to sit and talk about why. Why do you think there's an opportunity? How does it compare to the past that you've seen and are thinking about? And why we're paying attention to certain economic indicators.
Exactly.
So,
We got slides this time. This will be fun. And we're going to share this with all of Lumina clients. We thought we'd publish it to the public too. So, look, the headline messages are we're in an economic expansion, economy's strong, and we'll show the data behind that. Second, this is a bull market. Third, inflation is coming in sticky and hot. And that has a couple conclusions. One is Mr. Market's pricing in higher for longer. The Fed is getting their head around that. You're seeing that in the pre-FOMC chatter. And you're seeing that also in the 10-year moving higher, and that's going to cause some volatility over the next few weeks. And we think that when this wraps up in a few weeks' time, there'll be some compelling opportunities to get in the market. But we do expect some volatility ahead. So those are the main messages. We'll unpack that. I'm going to share my screen here.
is it the volatility that creates opportunity? Or is that
Yeah, it's yeah, sure. Look, the volatility, and usually when people refer to volatility, they usually refer to the downside volatility. But yeah, it creates opportunities to get good investments at a better price or worse, paying an overly valued price. It creates fear, and that fear is often a sign that there's a good potential opportunity to get involved. What we saw in the last few months, especially around semiconductors and a lot of chatter from raising $6 billion from OpenAI and all this stuff, those were actually peak sentiment moments, and the market's traded down since then on semiconductors. So yeah, volatility is it creates an opportunity. So here's some of the things we're going to discuss. One is on the macro side, earnings, and then semiconductors. And the first thing I want to point out here is, the economy continues to exceed expectations, right? This is the Citigroup Economic Surprise Index. You can see that it's well ahead of what consensus expectations are. So this is one of the reasons why a lot of investors are caught off sides and have been forced to chase this rally. And still the economy is outperforming expectations. Okay. And we expect that that'll continue, but it'll moderate, right? We saw, for example, 5% year over year spend on Visa network. Now it's around 3% or so. So, and the leading indicators are turning up. These are the leading indicators that notoriously missed kind of the October 22 bottom, but they've generally been reliable, and these are on the upswing. That's a good sign. Housing data came out today. The housing data was strong. Housing's a multiplier effect on the economy. So that was really good to see, despite the fact that you have higher mortgage rates. People are not selling existing homes, but they're buying new homes and they're investing in new homes. And this is one of the most exciting stories in the economy that no one's really talking about. Its productivity rates are strong. And that enables corporates to earn more. It enables people to earn a higher real wage after inflation. We haven't seen productivity rates like this since the late 90s. So even though there's a period of elevated inflation, even though there's rates volatility that I expect we'll see from the upcoming FOMC meeting, where I expect they'll be very hawkish, these are the bright lines and the that are supporting the economy and earnings growth. So I'll pause
so
there.
this chart is showing quarterly percentage change? Is that the right way to read these charts here?
That's right. That's right. Right. So productivity is a measure of how much output can you get per your inputs, and those inputs are labor, commodity inputs. There's more labor in the economy. Uh, Cost of commodities like lumber are dropping, which helps the housing sector. Other commodities have obviously gone up, but the fact that other commodities like oil have gone up is also a reflection of the global economy strengthening,
Mm.
and they've gone up, at a relatively measured pace, not in a way that is, too. So here's the price of oil, for example. So oil has ramped up since December 23 in line with the strengthening global economy. Obviously, it's come back a bit from some of its recent highs. So yeah, headline message is, this is a growing economy.
Within that growing economy, how do you think through the different investment themes that we at Lumina have? Like, is this a growing economy across all sectors, across certain sectors more so than others? And like, how do you think through that dynamic when you're looking for opportunities?
It's a great question. So as you know, we're thematic investors. We look for long-term secular trends that we can get excited about and invest in and look for, value at a reasonable price. So yeah, there are a few themes that we like. We have a whole separate document on our investment theme. So if people want to ping us, we can send that over to them. They're also on our website, by the way, lumina.com. But I think some of the themes that'll do well the back half of this year, home builders. There's a massive housing shortage. We saw earnings reports come out from DH Horton, which are strong. Another home builder reported earnings today, again, strong, despite the fact they've got higher mortgage rates, especially on that starter housing unit, affordable entry price housing in areas where we've got favorable geographic and demographic story like Florida and Texas, Southeastern United States. So we like that. We like the energy theme. The world needs more energy. Obviously, we picked up on this late last year. It's done very well for us, and now the market is looking at energy, and energy is great. It's got earnings, clean balance sheet. The valuations are cheap. We still like semiconductors too. Semiconductor run on a cycle, and the second half of this year, we should see an uptick in PCs and smartphones. Right now, what's driving the semiconductor cycle is the demand for GPU chips. Automotive has been weaker in that category. So this chart here shows the forward earnings on semiconductor. These are the expectations, that the line in red. Now, you might say that some of these expectations are getting ahead of themselves. That's possible. That's a different conversation. But the trend is up. This is a good category. It's a long-term secular trend. The world needs more GPUs. So those are some of the themes that, we're looking at. There are other themes we think will do well too, like biotech. But, we think a category like biotech will do better when the rate climate is more benign. So maybe in a few months' time, or when we see rate cuts in view, that'll be a good time to get into biotech. Small caps, you just got to pick your spots. Those that have earnings growth will do fine. Those that have significant debt burdens, that have refinancing issues, those could be a bit choppier. There's also a good story in travel and leisure. Boomers are spending money. They're getting more income because rates are also higher for longer. They're traveling. We see that in backlogs that have record levels for like cruise lines, for example. So those are some of the themes we like. Elderly care is an interesting sub theme within our aging demographics. We still like those themes. Those are good themes. It's just when you lean into them based on what we see today is what can change. I think today where we stand, home builders and energy are more interesting. I expect that once the market digests the higher for longer, then that'll be the time to focus on technology sectors, especially semiconductors.
So talk more about the dip, right? Like what is causing the dip if you're looking at a set of data that suggests strong economy and a growing economy? What's causing some pullbacks and some volatility and the compression in certain
I'll say a few things.
sectors?
So one is we had an incredible rally off the October lows. As you know, we were buying and encouraging people to buy the October lows. Uh, and what happened really in the last few months is markets got ahead of themselves. You saw earnings come out and stocks would jump 10%. This happened quite often. That's usually a sign of excess enthusiasm and sentiment in the market. We also saw record call buying activity relative to put options. That's a sign of excessive enthusiasm. When everyone's all in on the market, then it's hard to find that marginal buyer. So things take time to reset and for new money to come back in at more reasonable valuations. We're seeing that happen as well. I know stocks like Lululemon that are expensive relative to names like Nvidia. There are quite a few names out there that are like that have elevated valuations. So that is working itself. That's correcting. There are names that are indexed to the AI theme that have run up quite a bit. Some of that deservedly, some of that not deservedly, because they're not truly indexed to that theme from an earnings perspective. So all that needs to get ironed out. I'd say the big driver though is the 10-year. Like 10-year is an interest rate that drives valuation. And a rising 10-year means that long duration securities, because all securities are claim on future cash flow, are discounted less, and rate sensitive names are discounted less. And that's exactly what we've been seeing, in the market. This is a study that Lumida did internally. We looked at the performance of ETFs from August to October of last year, which is the last time we had the higher for longer rate story play out, and then what performed the best. And you can see that the sectors that did the worst were rate sensitive categories, including utilities and real estate and unprofitable technology, which is the same thing as saying long duration technology. So we think something similar is going to happen here, and then you can look at the sectors that perform on the other side of that.
So when do we have some upcoming FOMC meetings? It's not far away.
So May 1st is when the FOMC will conclude their next rate setting meeting. I expect it'll be hawkish. I mean, the data is strong and clear that inflation is sticky. I don't expect the Fed is going to raise rates. That would cause them to backtrack on the posture that they shared in the December meeting, where they have a bias towards easing. And you're already seeing a preview of the positioning. So that's one. And then the other key event to look at for is the CPI, which is going to publish on May 15th. So I think somewhere in the May timeframe, we're going to have attractive entries. And, we have more of a defensive posture now. We are excited about the data center trend, the semiconductor trend. We reduced our exposure to those categories despite that excitement, while maintaining a thematic exposure. Because it might be wrong. You want to make sure that if you get the bet right, that you participate in that bet. You don't want to get the bet right, but outthink yourself too much, right? On the other hand, we are seeing values, come in now. And the reason why we want to highlight this, including on this call today, is that momentum names have started to break down. And usually when momentum names break down, they start to have negative momentum. They keep going. They overcorrect in the other direction. So I believe what we are seeing the last few days is a relief rally. And, it's going to take a few weeks for the markets to process higher for longer. Markets have been expecting pivots and rate cuts, and that hasn't happened. They keep getting kicked out. And the markets haven't really cared because they just assume it's just the next month. It's the next month. I believe this time is different in that markets will lower rate cut expectations towards end of the year.
What happens when that gets priced in? Like, what's the price action when reality sets in? If that is the reality in which we find ourselves, that rates are staying higher for longer, we're not experiencing cuts.
We'll take a look at this. This is a chart of an ETF called MTUM. I highlight this because this has been a momentum-driven rally, and this ETF has a lot of names that are indexed to the AI theme and other themes like cybersecurity. And every time there's a CPI print, every time there's a CPI print or FOMC meeting, you can see that downside volatility hit. But by and large, markets have shrugged all of this off because the economy is growing and earnings growth is strong. So it hasn't really mattered. That's changed in the last week or so, right? So remember, you had the CPI print a few weeks ago on April 10th. And, this triggered what we believe is a new regime. And really in the wake of the last FOMC meeting, you've had different themes that are working. Energy is working, biotech's not working, for example. And technology hasn't really gone anywhere at the ETF level. Names within technology have done well since January 1st, but the sector overall hasn't really done well, and the valuations are elevated. So, if I would expect that this test at resistance fails, because I think this is a relief bounce, and we'll have volatility over the next few weeks, much like we had in the September-October timeframe of last year. Now you've got tech earnings that are coming up also, and that's going to influence this too, right? So Tesla report after the close. I expect they'll disappoint. I think everyone knows they'll disappoint at this point. That's one. Meta will report this week. I think they'll do pretty well, and that could help markets too. You've got Microsoft and Apple and Google also reporting within the next 2 weeks, and they'll have different effects. But look, Microsoft's got like a 95 percentile valuation, and there's a lot riding on the expectations of growth from Copilot, and they probably need more time. So, I think overall the market is gonna take some time to process this, and it does look, at the data, some of which I've mentioned here, appear to be a different kind of regime. So it's important just to be a little bit more attuned to positioning, and I think play for a pullback. And when you get a pullback, I think there'll be attractive entry opportunities. In October, we raised our hand. We say, hey, look, now's the time to buy semiconductors. And, they did very well. And you make your money on the buy. ASML was great in October. It's not great now or last month, for example, right? So, there's some nuance there. It's like, hey, look, economy's great. This is a bull market. It's an election year. But there is this recognition moment, or really a process that's playing out around what higher for longer rates means for these sectors.
Why does it have that impact on biotech? Like, what about the biotech industry causes higher for longer rates to have a negative impact on pricing?
It's one of the ultimate long duration assets. Number one, these are not cash flowing businesses, and unprofitable tech is a theme. You can track that on a watch list, and that category has the worst correlation with rising rates. Biotech is also an example, like animal spirits, right? When people get excited, they start buying biotech names. So, but yeah, that's a category, like we see a lot of promise and opportunity in that too. In fact, we actually bought 2 biotech stocks on Monday, but we know that we're not going to be holding them for a while. These are some of the better businesses we think in the category. If you look at the biotech sector today, I just pulled it up here on my screen. There you have it. Look, Monday was an excellent entry point. We saw that. We participated in that, and maybe there's a day or two to go. But that's our near-term outlook on on some of these categories. I think energy and home builders are good categories. They have earnings yield, they have momentum. Another chart that's worth sharing here is the growth to value. So this chart shows the growth to value spread. So when this is above the line, growth stocks are outperforming. When this is below the line, value stocks outperform. And when you have periods of weakness or corrections, value stocks are good safe harbors. They outperform. It doesn't mean that they necessarily won't decline in price, or they could do better. Like energy did very well in 2022, for example. Those stocks are up like 50%. So you can do well with those categories. People don't think that you can get those kinds of returns in value stocks, but you can. So, but you can see that there also has been an inflection point in that growth to value spread.
So what drives that, right? Like companies that are in growth mode are longer duration.
These are big philosophical questions, and there are different debates around what this is and all the rest. And I could tell you a theory based on financing conditions and all of this. And I've had these conversations with some of the world's most legendary investors around this. I'll say this, like the main thing is, look, growth was overextended, right? And the forward PE on the S&P is 21. You have tech stocks are at the 99th percentile valuation. That's it. So investors are looking at opportunity cost, and they're saying, look, if I buy $1 today of this security, how does that compare to the return I get on this other security? And they're starting to reassess and re-underwrite the menu investment options that they have available to them. And then things start to trend as well. So psychology starts to get into the storyline starts to get into why certain factors perform and don't perform. The important thing is to observe and see what's happening. And this is what we observe. And, it's consistent with some other phenomena that we saw as well. You had just a lot of excessive speculation the last few months, right? Like the Reddit IPO, the thing took off like a rocket. It pulled back. DJT meme coin took off like a rocket. It's pulled out. Well, those are all signs of excessive speculation. One of the days that marked this kind of turning point also is the expiration of options on last month. And, options are a way people express speculative views too, right? So markets climb a wall of worry. And if everyone's excited, everyone's so excited, they're levered long with call options, there's no wall of worry, right? So
talk a little bit more about opportunity costs, because I think that's an interesting concept, particularly when you're talking about specific investments, growth versus value, maybe specific sectors, but also here in this concept of buying the dip, right? There's opportunity cost in waiting. And I think it's important to discuss that at some level.
Yeah, price is what you pay, value is what you get. And, if rates are going to be higher for longer, and you expect that there'll be some digestion of what that means, then it's not a bad time to have a bit more defensive posture. To be clear, like we're not long, we're invested. It's important to do that because markets generally will go up. It's a bull market. The economy is strong, right? But I think all we're saying is there's a tactical moment here in the next few weeks, and we want to be positioned for that moment. So we make sure we have minimum exposures to all the themes we like. We want to participate in that, but we're not overweighting themes that we think got ahead of themselves.
When you say a theme got ahead of itself, maybe
right? Like,
can you break that down?
Yeah, a theme getting ahead. Like if for example the Fed were to meet in May 1st, and they're actually dovish. Like the last Fed meeting was quite dovish, actually. If you look at their expectations for inflation rates and the economy, then those themes or sectors would do quite well. That's why it's important to still stay invested. We might be wrong, right? I don't think we are, but we might be. That's what being humble about your approach to investing means. Taking a mixed strategy. Say, all right, we have our exposures here, but tactically, we want to play a bit defensively on the expectation that could be a pullback due to higher rates. Now, where do they go? Maybe 4.75%, maybe 5%. Who knows? We have to just track, wait, and see, just assess it as it comes in. But generally, what you're seeing is the 10-year, the US dollar, and oil price have been moving in concert. When that happens, it's usually kind of like a macro environment, and that is driving markets as opposed to exciting themes, which is what was driving markets from October 26th to the beginning of April. Those exciting themes range from AI to the biotech theme, to GLP-1s. There's a lot to get excited about. So, hopefully that nuance kind of explains how we are positioning going into this.
What does it mean to be defensive then in this moment?
Well, I think
you're sensing opportunity. You're saying there might be some tactical opportunity to buy the
overweighting value, like financials, even select quality financials, overweighting energy, overweighting home builders, then having a neutral weight on other themes like semiconductors, and really picking your spots within those tech companies. Like I did a post yesterday comparing NVIDIA to Intel and AMD. I mean, NVIDIA is leaving them both in the dust. So being precise about how you express those views also matters, including in the Mag 7. We saw Apple and Tesla. The dispersion in technology stocks is highest versus all other sectors in the S&P 500, meaning the spread between winners and losers is the highest in technology. So playing for more of a growth at a reasonable price versus owning a stock that's got a higher forward PE ratio than NVIDIA, which is the pace setter in the market. Just that little rule. That's why we got out of cybersecurity stocks, for example. That would have gotten you out of Lululemon. That would have got you out of Snowflake. And those stocks all have issues right now, right? So that's what it means. It means, hey, look, just be a bit more sober-minded about how you position. You still have exposure, but within those exposures, try to tilt towards value and earnings growth rather than things like sales growth. They sound similar, they're not. And focusing on quality businesses that have real moats. Those are the things that I would recommend doing where we are here.
So there's no crystal ball. You don't have it. Nobody has it. But how long does this opportunity last? Like how long did it last the last time you sensed an opportunity?
Yeah. So the last time we got excited was October of last year. And we were very vocal about this. We're very vocal. So I expect in the next 2 to 4 weeks, there will be a compelling opportunity. And, you want to be positioned to get after that. In general, it took about 4 to 6 weeks for the higher for longer story to play out last August to October. And we're 2 to 3 weeks into that. That's one way to think about it. But you still need an event. One of the things that marked the end for higher for longer, by the way, is a tweet by Bill Ackman. Just funny enough, this just how social investing has become and how mimetic it has become. But you're going to have an event with the FOMC meeting on May 1st. You're going to have another event with the CPI print on May 15th. If markets digest the CPI print on the 15th well, that's good. That means bad news is priced in. So you got to take it day by day, week by week. There's no magic date. Here's a date. You just have to assess it and then reassess. All right. If you see that, if the 10-year is stabilizing, that's great. If it's not going to go to 4.75, well, that's great too. Then if it doesn't go up from here, then everything I'm saying is wrong. That's true too. So, but in which case, you benefit from your minimum thematic exposures. But I don't think.
How often are you monitoring this when you say, you have to keep an eye on this? Is this
now's a good time to build cash, take advantage of, I think, a near-term relief rally. And if you have floating rate bonds, great, you're going to do well. And get ready for a rotation in a few weeks is how I would look at it. And in that rotation, you're going to want to go from those value-oriented names to hopefully we get great deals on wonderful businesses at great prices. That's what we want to look for. So,
and that rotation means you're then kind of taking advantage of the opportunity. You're being less defensive,
yes,
and moving some of that excess
yeah,
cash after
exactly.
selling into
Yeah,
compelling
exactly.
opportunities.
If you've got a floating rate bond that's yielding 5%, I doubt rates are going higher than that. That's an opportunity to sell that bond, or sell some of the more defensive names, and rotate into the securities that might be dislocated. We'll have to see, though. We'll have to see how the next few weeks play out. But yeah, my read is that this is kind of a relief bounce, that we do have a change in trend. Momentum, when it breaks, and looks to me like it's broken. So good time to play defense, build some cash, and when we get those moments and opportunities, then get after that. Now, look, you can also
I think that's a critical component, right? Is like being able to take advantage of the opportunity. It's one thing to say an opportunity may be around the corner, right or wrong, doesn't necessarily matter. But if you're not poised to take advantage of it when you were right,
yeah,
that matters.
Yeah, look, you can also zoom out. Look, if you don't have to play for every tactic also. It's a good economy. Markets are good. It's an election year. Funny enough, in election years, usually the weakness is in Q1. That hasn't happened this year. It looks like it's been kicked to Q2, which is now. So, be patient too. So I think that's it. I think that's what we wanted to share. And hopefully people found that of value. We wanted to share our latest thinking around this category. The future is exciting and bright. It's a great time to be alive. Price is what you pay, value is what you get. And Mr. Market is getting more disciplined around, these valuations and themes. So, I just want to position accordingly.
And if people want to copy this deck, they can just reach out on Twitter to Lumina Wealth.
Yeah,
to you.
That's a good way they could do that, or they could fill out the form on the website and give it to them that way also. We'll share more in our weekend Lumina Ledger newsletter on Sunday, but did want to share that. And we'll be tracking the next few days too. We'll be all over that. Excited to hear what Microsoft has to say. I think that's a key. If Microsoft delivers on Copilot and they've got earnings growth there and cloud is growing, then we're good to go. But if they disappoint, then I think the AI theme is going to be weaker. So that's a key one to stay on top of this week. All right.
As we track that.
Yep.
All right, Ron. Thanks.
Take care. Be well. Bye-bye.